SpaceX IPO shows how investors in public companies are losing power. That's the headline from a New York Times investigation by Aruni Soni and Joe Renison. SpaceX recently listed its shares on the Nasdaq with a two-tiered stock structure that effectively concentrates control in the hands of its founder, Elon Musk, and a tight circle of insiders. Here's how it works. The company issued A-class shares to the public, each carrying one vote at the annual general meeting. But it also created B-class shares, each carrying 10 votes, and those are held almost entirely by Musk and his inner circle. The result? Even after selling more than $85 billion worth of stock in a record-setting initial public offering, Musk still calls the shots. He owns about 40% of SpaceX's equity but wields over 80% of the voting power. This pattern isn't unique to SpaceX. It echoes what we saw with Alphabet when it went public as Google in 2004, and with Meta when it listed as Facebook in 2012. Today, Larry Page and Sergey Brin together own roughly 10% of Alphabet but control more than 50% of the votes. Mark Zuckerberg owns about 13% of Meta but controls around 60%. The sheer size of these companies means these voting structures now carry enormous weight in the stock indexes that benchmark millions of Americans' retirement savings. According to data from Refinitiv, more than 15% of the S&P 500's total market value, that's roughly $10 trillion, is accounted for by companies with unequal voting rights. And that figure doesn't even include SpaceX, which carries a market value of about $2 trillion but isn't yet eligible to join the index. The trend is only accelerating. Last year, 20% of all IPOs featured unequal voting rights, up from just 9% 2 decades earlier, according to the analytics firm ISS Corporate. Critics argue this undermines a bedrock principle of public markets: one share, one vote. Kyle Seeley, head of stewardship for the New York State Common Retirement Fund and a board member of the Council of Institutional Investors, puts it plainly. He says shareholders are the owners of the company, not the founder. When a company comes to the public markets for capital, the public becomes the owners. Many founders, he adds, simply do not see it that way. In May, the New York State Retirement Fund sent a letter to Musk directly raising these governance concerns. As more megacap companies adopt this model, the question facing regulators, index providers, and everyday investors is whether the principle of shared ownership can survive or if we're witnessing a permanent shift toward founder-controlled public companies. Thanks for listening, and stay tuned for more on how corporate governance is reshaping your portfolio.